Good morning, ladies and gentlemen. Today is October 29th. It's early in the morning on Saturday. In this video, we're going to go over the U.S. real estate market conditions, the rotational modeling system, and then we're going to discuss what may happen over the next week or two related to continued earnings, Fed, and the changeover into the pre-holiday season, Thanksgiving, Christmas, potential Christmas rally, which may close the end of the year quite a bit higher for the S&P and the major indexes, and particularly technology. So let's go ahead and start with the U.S. real estate market conditions. So this is updated data as of last Thursday. It's actually a week behind. You can see that price reductions have shot up. Active listing counts have shot up. Median days on market, which is this gray line, is kind of flat line. Price reduction share, which is this light blue line, has shot up. And median listing price, which is the blue line, has actually been moving substantially downward since June of 2022. That means that the market has really shifted gears. We're no longer seeing massive price appreciation. We're seeing price appreciation actually weaken back down into these lower levels, this 0.1314 area. We're seeing active listing counts shoot up excessively. And we're seeing price reduction counts skyrocket back up above 100%. Pretty much everything on the market right now is being reduced. That's telling you that sellers are desperate to kind of get out of the market at the best price they can. They are reducing inventory, but probably not by much. 5, 10%, maybe 15% in some areas, depending on how desperate they are. But this is going to continue to shift the way the market works. So you can see here my dynamic price modeling trend is moving downward. The orange line is really the modeled market demand. So demand is weakened, and demand will likely continue to weaken a bit, but the real price factor is moving downward as well. You can see last week the real price factor dropped by 1.787, and the model market demand dropped by 1.895. Really quite ugly. The second page here shows us the real estate price trends. Price trends have nominalized down here near the zero level. They're starting to move back down to the downside. Real estate price reduction activity is shot back up to the upside. You can see it up here. And you can see share of market, which is right here, is pushing up into the 85-90 area again. Real estate active listing counts have started to move back up higher. So this was a pause in new listings came in the market. Now they're coming back in and they're being reduced. And new listing count metrics shows you here, new listing counts are up to 36.20. So this is a big jump in new listings. New listing account change is 0.68, and share of market, new share of market is 0.08. So you're starting to see houses flood into the market, and we're not even started, folks. Interest rates are up. Everybody thinks the Fed is going to pause. Depending on what the Fed does and how long they keep rates elevated trying to fight inflation, we could see this trend, this shifting trend, take place for another 12 to 24, possibly even 36 months before it shifts. Now, I've created this next new page just today. Okay, so I want you to be aware that I've created some new features to try to show you how the market is working. First, we have the heat rank. Heat rank measures how hot the housing market is, and it goes through cycles and phases. This is not going all the way back to 2017. This is only going back 2 years, trying to keep it the last 2 years with the data so you can see what's going on. You can see that the heat rank really kind of spiked back here in May, June, July, and has now weakened considerably. This tells us that the housing market is really shifting back down into this very deep contraction phase, but it's doing so on a slower basis. We don't have that real panic selling phase yet. The real estate tightness rank, which measures how tight the market is, whether we have a lot of inventory or a very strong amount of inventory or not a lot of inventory, and how aggressively the market is changing hands. What this is telling you is that we are starting to become very, very loose. We are starting to untighten the market. We were at very high levels back over here in July and June and July, really kind of peaked out over here. And this, as you can see, gets very, very peaky. And then we get into these very looser periods. This is when prices decrease, activity spurs, possibly a flurry of activity. But in my opinion, we're seeing some real weakness in inventory. You can see here, this is the lowest inventory strength level that we've seen in 2 years. So what that's telling you right now is that even though there's more inventory on the market and people are trying to dump their houses, this is not a very strongly, a very in-demand inventory. This is a very weak inventory level in price weakness, in market weakness, and in heat rank weakness. We have not seen this type of a low price level since way back over here in 2021. And again, this was right near the peak. If you actually look at it, this was the peak in the market, the February-March peak. We had a little bit of tightness at the end, then we had a big rollover in April, May, June of 2021. We're now starting to get into that type of a period where we could see it move quite a bit lower. And then lastly, what I've created this new feature called seller desperation. What this is designed to do is show us how desperate sellers are to try to get out near the top. When we get to a point where seller desperation gets higher, that means that everybody's trying to dump out. When seller desperation moves lower, that means that sellers aren't so desperate. They'll sit on it. They'll wait it out. They'll wait for the Fed, see what happens. So you see here, June, July, August, we had a lot of seller desperation kicking in. People were actually trying to sell out at the peak. And that's back here. This is this tightness ranking. They're basically trying to sell out at the peak. We had a lot of people trying to dump. And then we had the same type of scenario here. Now we're back into this lower moderate level for seller desperation. We haven't reached extreme levels, although seller desperation is up considerably. The heat rank is off by negative 1.11. Tightness is off by 8.73, meaning we're getting into a not necessarily a tight, a looser market. You're going to find broader price decreases, broader deals being offered and accepted. Inventory strength is down 0.38. That means that right now you've got prices coming down. You're not seeing appreciation in inventory. You're not seeing a high turnover in inventory. This is basically, let's make a deal and try to get a house sold. And then, of course, seller desperation is moving quite a bit higher. Now, next, what we're going to do is we're going to come over to the rotational modeling system, and we're going to highlight that the weekly SPY is still bullish. The daily SPY is still bearish. That's 75% of our position. We're still got 21% in the, almost 22% in the weekly trend. We're at 2.73%, which has gone down a little bit over the last week. In our daily position, we are net short 50% in the SPY and 50% cash with a current profit at 2.73%. So nothing has changed. We're still sitting in the same scenario we were last week. We have no change in the trending going on right now. Everything is just really kind of flattening out, waiting for what may become a fairly solid Christmas rally. We're not modifying our allocation levels, although bonds do look like they're setting up a deep V bottom. We'll take a look at that next week, see if there's any new triggers. There are none yet. And again, we have our historical results on the rotational modeling system are still performing very, very well. I will be updating these on Monday when we get the activity through the beginning of November. So we will have some new data next week for you on this. Now, when we come back over here, and really, we talked about this in the other video, I'm still expecting a wave 5 rally to the upside. Like, we're going to have to see how this plays out for the market. So I want you to understand that we may see some real weakness in the market over the next couple of weeks, but I'm expecting a wave 5 rally, and I'm expecting the base that we have right back in this level right now to become the actual bottom of the market. So what I'm going to do is I'm going to try to draw something to show you that this base level right around here is extremely powerful related to future opportunity for us moving forward. Now, how powerful am I saying? Right now, this has become a very solid bottom in the market. It has become the big kahuna. This level is going to determine whether or not we are going to see upward activity moving forward or downward activity moving forward. So this level right here, this dashed green line near the upper level of this blue box right here, was the bottom last week here on the NASDAQ, actually 2.5, 3 weeks ago. And now we need to see if we start to accumulate activity to the upside. And when I say accumulate to the upside, what we're really looking for, ladies and gentlemen, is a continued rally at this point to get above this next level, which is 11,838. You spread this out so you can see it. This level here, 11,838, right there, that purple level. That's our next objective. We have to get above that to see any type of upward activity. And then our next objective is going to be right here, which is going to be approximately 12,930, 12,950 roughly. And at that point, it becomes critical. That means that we are now going to be trying to take out a previous peak level. And that's going to be one of the very first things we want to look at to see if we have any upward strength left. If we're able to take out this level, then we are likely to see some more upward strength and some real advancement into the Wave 5 Christmas rally that I keep talking about. And the same thing is happening over here in the S&P. So when we take a look at the S&P, I want you to be aware that we're looking at the same type of setup. So here's our bottom. Okay, here's our support level, which we have to pay attention to. I will change this to that same green color so you can see. Make this as thick as I can. And tell you that this level is our current resistance support level. We got above it just a little bit last week, but we need to see it get higher. And we need to see the S&P get above this level right here, 4,175. So 4175. If we can get above 4175, then we have a very strong chance that we're going to continue to move into a Wave 5 Christmas rally. It will have taken out a previous price peak, and this deep support way down here, which understand this deep support was the support from that 2011 to 2012 peak. See if I can drag this out here and show you. There it is, that line back here from 2009, 10, 11, all the way across here, 2015 peak. That support channel or resistance channel turned into support right now. And as long as we're staying above this level here, we have a very strong chance of upward movement. We are still apexing. You can still see the apex over here. So if we were to count 1, 2, 3 up to here, 4 possibly back down to here, and then possibly a move up, that could still happen as well. And what that would look like, if we don't see a big Christmas rally, if we don't see a breakout, then what we're looking at is, let me make sure I've got the right stuff here. Oh boy, I got lots of lines on here, don't I? Okay, got rid of all of those. Now we'll come over here, find my pen. What we would be looking at here is a wave rally up to here, a pull back down to here, a rally phase up to here, a pull back possibly back down into here, or maybe back down into here, and then an apex right here. And then we would be looking at an apex move out. And that would put us at about May, June of next year. So somewhere between, call it April, May, June of next year, 2023, maybe an apex pattern. Or if we get the rally phase that I think is going to happen, then we'd be looking at more something like this. A rally up into 4,400, 4,475, brief little pullback in the end of Q1, beginning of Q2 of 2023, and then a potential extended rally into the end of next year. Remember, I believe that based on cycle patterns, we're not going to have any major crisis take place for quite a while. Now, let me see if I can come over here and find the S&P. There it is. See if I can move this over here. Drag this over. Okay, so this is the cycle patterns on TradingView, and this carries all the way through the end of this month. So we have, through the weekend here, we have a crush pattern on the 28th, which was here, the 28th. We have a gap potential and a top resistance. So next week, we could see kind of a little gap up starting on Monday. We could see a bit of a little resistance here, moving a little bit sideways, and then continuing to move higher. I'll post these cycle pattern data into the TradeTank.com website to keep you all aware. But we've looked at this last week. I mean, it's quite obvious when you look at these bars how it nailed it. So these bars I drew, the green, the red, the little blue back behind here, and then the green. And this was just my interpretation of what I thought would happen a week in advance, and it just nailed it. So now we're looking at a little topping pattern, possibly a little consolidation, and then more of a rally. So pay attention, guys. I'm going to post all this up for you today and tomorrow. So that's it for now. And follow me on YouTube. Follow me on Twitter. Let's make some money in the markets this year. Live Trades has been killing it with great triggers with Pure Alpha. And the weekly TT scanner signals have been a little mixed over the past 3 weeks because of this sideways market trend. Remember, when you come back in here and you take a look at this on a weekly basis, yes, we've had some pretty solid trending, but we've also been in this I don't want that. We've also had this moderate sideways trending. So we've got this big flattening, this extended weakening signal, the end of our wave 4 pattern potentially here, the shifting back over here to wave 5 potentially. And when you think about it, since March of this year, when you really take a look at this, since roughly here, well, if you take a look at this range to here, we've been in a very broad 1,000-point range sideways trending phase. So we could stay in this sideways trending phase for at least another 6 to 20 weeks, maybe longer. We need to get out of this range to figure out what's next. I believe we've ended at least wave A to the downside. So understand that this is the end of wave A. We've got A, B, C, D, E. That's going to complete A. I believe it's wave 4. I believe we're going to start a wave 5 to the upside based on the longer term picture. But we could form an A move here, B move here, C move deeper, and we could see extended downward trending. Everything is very contingent right now about how price moves, whether we see strength in the U.S. markets, whether we see shifting in the Fed, whether we see risk factors mitigating. Everything is very early stage right now simply because we do not have any indication that the markets have totally shifted gears. We will know once we start establishing some new highs up here, and or if we rotate around and start to form into any one of these two patterns. This would be an extended pennant flag formation. This would be a breakout phase starting wave 5 a bit earlier. But again, we will know over the next 6 to 12 months. In the meantime, we need to stay cautious and prepared and protect our capital and take advantage of trends where they're available. All right, guys, talk to you soon.